Chapter 26.
Economic scale level, public sector borrowing and public sector debt, fiscal deficits and fiscal surpluses. But before we go into that, when talking about public sector, we're simply talking about that sector that belongs to the government. That's why it is public sector. And whatever happens through the public sector is done through government's policies. It simply means it's about budgets, taxes, which they sort their revenue before they spend. So we're going to start with fiscal deficits and fiscal surpluses. A fiscal deficit is when government spending is greater than its income, also called revenue, in a given year. A fiscal deficit means the government must borrow that year to finance its spending. A fiscal deficit is often measured as a percentage of a country's GDP. For example, Kenya fiscal deficit in 2017 was 8.46% of the value of its GDP. So the global financial crisis of 2027 and '08 led to large increases in fiscal deficit throughout the developed world. So there's fiscal deficit, which simply means government spending is more than its revenue. And if those such spending occurs, it simply means the government of that country would have borrowed to finance its spending, and that is national debt. It's going to accumulate to become a national debt. Are you getting me?
Yeah.
So then we have fiscal surplus. This is when government spending is lower than its revenue in a given year. So there's fiscal deficit, there's fiscal surplus. It's surplus because spending is lower or is lesser than government revenue. So
And
government revenue is greater.
okay, is that a good thing?
Yeah, surplus. Yeah, surplus is a good thing. Surplus means government is managing its budget well, and that is because it's good because it also reduces national debt.
Mm.
So that's about fiscal deficit and fiscal surplus. I think surpluses. I think that is clear, right?
Yeah.
Okay.
Sir, is there a country that doesn't have national debt?
I doubt it. I doubt it. Well, maybe, but it's weird, except maybe for planned economies. We
Mm.
simply, and it's there's no way you want to run your economy without debt. You,
Mm.
you can't tell me that every year that passes by. Look at during the global financial crisis.
Mm.
Yeah, it affects all developed countries. So which simply means some developed countries might not as well. America is having over
Like,
billions,
no, it's like 30
3
trillion, yeah.
trillion in debt. So that's America.
Yeah, but America's economy is based on that. Like the US dollar is based on that.
Yeah, but the point is you can't you can't be self you can't be self-sufficient. It's not possible because you deal in things that you don't even have, that you can't have control over. So most of these debts comes as a result of you not having control over what you are getting. If the price of crude oil increases in the whole economy, if you don't have crude oil, you don't have any say about it. So that means you might as well have to increase your budget to import crude
Mm.
oil.
Okay, so no, sir, when when countries take debts, who do they take it from?
Taxes? Take
No,
what?
no, when a country like has like wants to take a loan, what does it take it from?
The country, IMF, International Monetary Fund,
Mm.
or even individuals,
Who funds the IMF?
the World Bank. The World Bank, it's a body on its own that decides. It's not funded. It's a body.
But like how does it have money to give out loans?
IMF. It's the World Bank. So all treasury goes through the World Bank.
Mm.
Yes, it's a treasury. So everything goes through the World Bank. It's the apex of all banks. So it is expected that they have.
Mm.
But how did they get it? Nobody's going to tell you that. But it's the Apex Bank. So Apex Bank is expected to have whatever you need. So IMF is just a branch of the World Bank. So whatever money it needs to get through the World Bank, it goes through the IMF.
Mm.
So countries go to the IMF, countries go to institutions, country gets money from. Yeah, you can get money from even individuals
Mm.
through bonds. Countries, sometimes they even have to sell their treasury bills. to raise finance, not only through taxes, especially when it comes to deficits in their own, when they have deficits. Does it make sense now?
Yeah.
So fiscal deficits and national debt, that's where we're going now. Okay. Safe to drive, I'll talk about that later. Let's continue with it on live then. Okay. So for fiscal deficit and the national debt, I said national debt is the total borrowing of the government which remains to be paid to lenders. Fiscal or budget deficits or surpluses have a direct impact on the size of the national debt. If there is a fiscal deficit of, say, $20 billion in 1 year, then the national debt will increase by 20 billion. If there is a fiscal surplus of, say, 30 billion, then the national debt will decrease by 30 billion. That was the question you were asking me before. Is fiscal deficit, sorry, I did not. Did I have there? Okay. Then you said, is fiscal surplus or deficit a good thing? If you're having a fiscal surplus, it means your national debt is decreasing. And if you're having a fiscal deficit, it means you're increasing your national debt. Because a fiscal deficit means the budget has to be executed. And if the budget has to be executed, you have to spend from what you don't have. Then how do you get what you don't have? You get what you don't have by borrowing. That's the point I'm making here. So an important point to understand is that a fall in the size of fiscal deficit over time still means national debt will be rising. However, it does mean that national debt will be rising at a slower rate. So a fall in size of fiscal deficit means a fall in national fiscal deficit means your national debt is reducing at a low rate. But it doesn't mean you don't still have. But it simply means you don't have the huge amount you used to have previously. And that's the point there. So then we have fiscal balance. And national debt they say fiscal balances and national debt can be measured in two ways. One way is to measure them in money terms, such as 10 billion. Another way is to measure them as a percentage of GDP, such as 3%. So the GDP measures is often more useful because it gives an indication of how easy it will be for the government to finance a deficit, or how easy it will be for the government to repay the national debt. You can measure it in monetary form, which simply means you are taking money from wherever you're taking it from. But it is ideal to measure it with GDP, because it simply means, GDP is the measurement of your PPC. So it simply means, this country has a fiscal deficit of 3% of its GDP. So we know that we only need to increase our GDP by 3% to knock off the fiscal deficit. So we just have to outdo our output to knock it off. But if it comes to the amount, it simply means you've taken a money that you might not be able to produce to recover it from. Do you get the point I'm making there? So they said, compare this to an individual. If a worker borrows $1,000 and his income is $5,000 a year, the debt incurred is very significant. That's 20% of his income. It could show he is in serious financial difficulty. If a worker borrows 1,000 and his income is 100,000 a year, the debt is relatively trivial at 1% of his income. It is likely to be a little consequence. So because it's percentage, you can as well quickly check it. Oh, I'm owing 5% of my salary. Oh, that's huge. But when it is in monetary form, you wouldn't, you would like, okay, it's 10,000 to 1,000. Okay, I will pay 1,000. But when it is percentage, then you start thinking more about how are you going to recover it. So national debt as a percentage of GDP can vary significantly between countries. For countries such as Saudi And UAE, state ownership of oil reserve means a large source of revenue for the government comes from the sale of oil on export markets. This explains the relatively low levels of national debt as a percentage of GDP for these economies. In 2017, Saudi Arabia's national debt as a percentage of GDP was 17% in the same year. Japan's national debt as a percentage of GDP was 236%. When a government borrows money, it issues debt in the form of government bonds. Purchasers of these bonds have lent money to the government. In return, the holders of these bonds receive interest. The yield on the government bond is the interest rate paid to the holder of the bond. Purchasers of government bonds include pension funds, insurance companies, households, and overseas investors. Like I told you earlier. A country can as well borrow from individuals. Well, as long as government wants to borrow, they issue what we call bonds. So as a bond holder, it simply means you have given money, you have lent government money. That makes you a bondholder. Does it make sense there? So government can as well borrow from individuals, institutions, financial investors, financial borrowers.
So the government can owe me money.
Yeah, if you have. Then if you have, government can approach you and you discuss the interest, and that's it. It's safe borrowing more government money than borrowing individuals, don't you think? Or borrowing firms.
Depends on the country.
No, the government is going to pay back because it's a bond. It's on them. When you have government bond with you, it's huge. So government is in debt to you, so they have to pay back. And government would definitely pay back. So it's a secured loan. It's more secured because it's the government giving it to you. Government owns this country. So we go to automatic stabilizers and discretionary fiscal policy. For automatic stabilizers, it results from a set of rules largely on welfare payments, income tax, and goods and services tax, which influence how much the government spends and raises in taxation without any intervention by government policy makers. Automatic changes in fiscal policy instruments help to reduce variation in the economic cycle. Government spending and taxation are both automatic stabilizers. This means changes in government spending and tax revenue occur automatically as GDP changes. So for automatic stabilizers, we're simply talking about changes in the GDP that will automatically reflect on what government is spending and what government is taking in return. So a change in the GDP would automatically change government thinking, government finance, government budgets. And that's automatic stabilizer. So if the GDP is growing, it is expected that government revenue would increase, government spending might also increase. These are automatic stabilizer. So when the economy goes into recession and unemployment rises, the government automatically increases its welfare payments, spending, paying out more on unemployment benefits and other related benefits. So look at the situation here. If the economy goes into recession, it means there's decline in economic activity. A decline in economic activity simply means governments have to spend
less.
No, more. Unemployment is reducing. Unemployment is increasing.
Okay.
The economy is in recession. That means if a decline in economic activity. So government has to boost the economy as a result. And for government to boost the economy, government needs to spend. Government spending would increase aggregate demand, and that would automatically improve economic activity. Do you get it? Tax revenue fall too at a faster rate than the fall in income. This is because income tax rates tend to be higher on marginal income than on average income. Income tax is a progressive tax in many countries. For instance, a worker paid on commission may sell less in a recession. His tax rate might then fall from a higher rate such as 40% to a lower rate of 20%. Also in a recession, household spending or consumption falls. It is likely that luxury consumption will fall more proportionately than spending on more essential items. The VAT, known in some countries as Goods and Services Tax, GST, has zero-rated items on or much lower rates on many essential goods. When household spending falls, the reduced spending on non-essential or luxury items result in government collecting less tax. During recession, it is likely that people would want to spend on necessities. Well, why spending on necessities at that period of time would only be encouraged if government find a way to reduce VAT. And government reducing VAT will encourage people to buy, but it simply means government revenue through taxation would fall. That's the point I'm making here. Does it make sense? But for non-essential or luxury, it is proportionately to income. That's why it is always elastic in demand. So it is when your income increases that you think about buying such goods. Do you understand? So the effect of automatic stabilizer in a recession means aggregate demand falls less than it would without these stabilizers in place. So without automatic stabilizers that we talked about, during recession, aggregate demand would fall. And that is why we have automatic stabilizer. Because during recession, it is expected that government of a country spend more so that aggregate demand would rise. Because during recession, aggregate demand is expected to fall. So it is automatic because government has to respond immediately based on the situation. GDP is falling, government has to find a way to increase it. GDP is growing, government must also make money from that. Does it make sense here? So if GDP of a country is increasing, automatically government revenue would increase. If GDP of a country is falling, automatically government spending would increase. These are what we call automatic stabilizers. I think it's making sense now, right?
Yeah.
So in contrast, when an economy experiences high economic growth, government spending falls as the total amount spent on welfare payment falls automatically. Look at what they said there. In contrast, when an economy experiences high economic growth, which is simply an increase in GDP, government spending is expected to fall, and tax revenue would what? Automatically rise. So tax revenue increases at a faster rate than the increase in income. An unemployed person would pay very little tax. When the unemployed get jobs, they start to pay substantial amounts of direct and indirect tax. So aggregate demand is lower than it would otherwise have been with these automatic stabilizers. So the opposite is discretionary fiscal policy. This is the deliberate decision making by government to change rates of tax, introduce new taxes or change levels of government spending. For example, a government may make a policy decision to increase its infrastructure or health spending. For discretionary fiscal policy here, government would try to find other ways to ensure that government spending is productive. Do you get it? Government spending is productive, and that's why they will spend on infrastructure. That's why they will spend on healthcare, because spending on infrastructure would attract FDI. Spending on infrastructure would reduce the cost of production for firms. Spending on infrastructure would make investment attractive. Healthcare also, it increases the living standard, it increases the life expectancy, and it makes the workforce to be more healthy. Do we get it here? So that's about automatic stabilizer and discretionary fiscal policy. For stabilizer, it's all about situation regarding the GDP that would automatically. Yes, pardon, please. Yes, sir. One, sir, yeah. So for automatic stabilizer, like I said earlier, it's going to be as a result of the GDP of a country. So whatever happens to your GDP would automatically have effects with government spending or government revenue. Therefore, discretionary fiscal policy, it's about government trying to spend on strategic area of the economy to boost the GDP. I think it's clear. Now go to cyclical and structural deficits. The size of a fiscal deficit is influenced by the state of the economy. Because of automatic stabilizers, government spending and revenue is very dependent on whether an economy is experiencing a period of negative economic growth or positive economic growth. That's for GDP. Quite often, an economy will experience changes in economic activity, which follow a pattern. This is called a trade cycle. It's a pattern. So what goes wrong comes back to the same situation. A trade cycle tends to have four phases. A peak, which is the same as a boom, is when the economy is working at above full employment, the economy is overheating, and national income is high. This is followed by a recession, when economic growth is negative. When GDP is at its lowest, the economy is in a slump. The final phase in economic recovery is when the economic growth is positive again. So a decision can be made between cyclical and structural deficit. A cyclical deficit occurs because government spending and revenue change through this trade cycle. When the economy is growing quickly during a boom, spending on welfare benefits such as unemployment benefits is likely to be relatively low, and tax revenue are likely to be relatively high. Now, for structural deficits, the difference between cyclical and structural deficit. For cyclical deficit, government spending occurs based on situation of the trade cycle. That is cyclical. But for structural, it's based on how the economy is, the nature of the economy, what are the GDP of the economy, what are those things the economy has. So when the economy is going quickly, they said when the economy is going quickly during a boom, spending on welfare benefits such as unemployment benefits is likely to be relatively low. Because during the boom, we said for cyclical deficit, it's all about how government spending occurs during the trade cycle. Deficit is likely to occur during recession than during a boom. Are you with me? Because during recession, government is likely to borrow to increase spending. Because during recession, tax revenue is expected to fall.
Yes.
So which simply means government budget for execution will not be enough. So lending would increase. Government lending would increase. That increases national debt.
Mm-hmm.
And that is about cyclical. So for cyclical deficit, it occurs based on the trade cycle. Boom, government will spend less.
Mm-hmm.
National debt is expected to fall. During recession, government is going to spend more. National debt is expected to rise. I think the point is clear.
Yeah.
So let me see here. They said, okay, figure 1, there's a social deficit in the economy of 2% of GDP because lowest level of the cyclical deficit is 2% of the GDP. It's structural because it's all about the GDP of the country. Whatever is being produced, that is it. So at the time, okay, yeah, this let me just see. They said government can also have structural balances or structural surpluses. A structural balance occurs when at the peak of a boom, the actual fiscal balance is 0. A structural surplus occurs when at the peak of a boom, there's actual fiscal surplus. So when it is 0, that's balance. That means no deficit, no surplus. But during the boom, a structural surplus occurs if you have fiscal surplus. So it's still the same, like what we've been talking about. Government spending reduces because GDP is increasing, and that might as well bring about a surplus. If everything is equal, then there's a balance within the structure. And if spending increases more than revenue, that's a deficit, which comes through the structural or cyclical. Okay, let's look at this at point A, C, and E. Wait, let me see what they say here. Well, I'm just going to explain it. For the social deficit, I think it's clear. It's based on how much more you spend when your GDP is falling.
Mm-hmm.
And surplus is how much more you spend, how much more you have when the GDP is growing. Does it make sense?
Yes.
Okay. Okay, they said in figure 1, at no point in the trade cycle is the budget in surplus. The best position it reaches is a deficit of 2%. This 2% then represents the structural deficit for the government. The structural deficit is the fiscal deficit which occurs when the cyclical deficit is lowest. This means that actual deficit is equal to the structural deficit plus the cyclical deficit. So, well, for actual deficit, that's the amount the government is owing. And it is based on how much GDP has fallen and how what is happening within our trade cycle. The GDP is falling and the economy is in recession to the trade cycle. So these two, when you put them together, it gives you actual deficit. So there's deficit here because the GDP is falling, and there's also deficit because the trade cycle is in recession.
Okay.
Actual deficits. Let me see this. Let's say the social fiscal deficit. I'm just going through them again. The social fiscal deficit in the next line here. The social fiscal deficit or surplus is sometimes called the cyclical adjusted deficit or surpluses. Cyclical adjusted means that the effect of automatic stabilizers on government spending and taxation have been taken out. If the government has a structural deficit, it is likely that the national debt will grow over time. This is because whether the economy is in boom or in recession, it will still have to borrow money to finance its spending. Therefore, economists argue that structural deficits need to be eliminated. Governments should either raise taxes or cut government spending, or both to eliminate the structural deficit. So the point about for cyclical, you can as well work on it because it's based on how much more the economy has moved from recession to boom or to recovery. But if you're having a structural deficit, it is more beyond your trade cycle. Whatever happens, if either your trade cycle is in recession or in a boom, you still have to borrow because the structure itself the GDP of that country is at a low, which simply means whatever is being produced in that country is not enough to finance its spending. So do you understand the point they're making here? So for structural deficit, and if an economy is in structural deficit, it simply means irrespective of whatever your economic cycle is, you still have to borrow to finance your spending. And to reduce structural deficit, you have only two options: either to increase taxes or to cut spending. Is it clear?
Yeah.
So some economists argue that in practice, it is impossible to calculate the cyclical or structural deficit of an economy. This is because trade cycles are not regular occurrences, and they don't have the same size each time. For example, the financial crisis of 2007 and 2007 and 2008 was the worst recession for many countries since the Great Depression of the 1930s. It was not predicted by the majority of economists and politicians. Looking back, it is possible to see that many countries had structural deficits in the decade before 2007 and 8. However, at the time, economists and politicians assumed that many countries were running structural surpluses. The debate is similar to the one about output gaps. An output gap is a very helpful economic concept, but sometimes some economists argue that it is impossible to measure accurately because no one knows exactly what is the productive potential of the economy. So, yeah, you might think you are running a structural surplus because it's within your control. But when recession comes in, recession is beyond your control. And before you know it, your surplus becomes a balance or deficit. So, and that takes us to talking about output gap. When there's output gap, it simply means the economy is booming. But how much more can you measure the output gap? Because when there's output gap, to you, it simply means resources are fully employed. The country is reaching the apex of its productive potential. But what about other factors that are not put into consideration during using output gap? So it is difficult to understand. It is difficult to accurately, measure an output gap of an economy, because an economy does not only depend on itself. It depends on other factors that are beyond the control of that economy. There's war. So if you have had a budget, the war would interrupt how your spending would be. So your expected revenue for those countries that rely on exportation of oil, now there's blockage of oil. So it simply means part of what they have expected, that part of what they have projected to get in terms of revenue would reduce, which they have budgeted for spending also. So these things will happen, and they are beyond the country's control. And before you know it, some countries will declare increasing debts within the next few months based on events that they were not the one that initiated, but they are external factors which affect their own sort of revenue. I think it's clear there.
Yeah.
So we go to current budget deficits, primary budget deficit, and actual budget deficits. A decision can be made between current expenditure and capital expenditure of government. Current expenditure is government consumption, such as the day-to-day spending on education, defense, health services, welfare payment, and debt interest. Capital expenditure is government spending on investment goods such as new roads, new schools, new hospitals. Now, let's look at it this way. There's current expenditure for government, there's capital expenditure for government. We have current expenditure for government because these are day-to-day recurring expenditures for government. They are recurring. That's why they are current. But as soon as government initiates a new project, it becomes a capital expenditure. So that's why education will be current expenditure. New school would be capital expenditure. But as soon as the school is built, now spending on the school starts, and that becomes current expenditure. I think it's clear. So now we have a current budget deficit, which occurs when government revenue are less than current expenditure. The government is not covering even its day-to-day spending and has to borrow money for this. When the economy is in recession, there may well be a current budget deficit as the government attempts to increase aggregate demand. However, over the trade cycle, economists argue that the government needs to run a current budget surplus. So we have a current budget surplus, which is based on day-to-day spending of government. So government would only have, for current budget surplus deficit, it simply means government is spending more than what it has. Even government is unable to cover its day-to-day expenditure. So that means government is borrowing to cover its day-to-day expenditure. Do you get that? So do you have the phone here?
Auburn.
Hold on, please. Let me just. 2, 3. Let me just pause this. Pause. Okay. Okay, so stick here. Okay, thank you.
Wait 1 second, I need to just.
Okay. So we're still on current budget deficit. Thank you. Okay. So, like I said, for current budget deficit, it is a current budget for current budget, it's all about government spending on day-to-day activities, like we said earlier. Then there's current budget deficit, which simply means the government of that country or the government of a nation is unable to spend to finance its day-to-day expenditure without borrowing. So that means the day-to-day expenditure is not being covered except through borrowing. So that is what government budget or current budget deficit is. So they now said, however, over the trade cycle, economists argue that the government needs to run a current budget surplus. So yeah, because it's current budget, how will a country not be able to finance its day-to-day activities? So that means the country is in a big debt. So this is because government must also invest for the future. So if you cannot invest, if you cannot cover your current budget, how do you want to talk about covering your capital budget? Because current budget is just about your current expenditures. You cannot cover that. Then how do you want to cover? How do you want to come up with new projects? And investment in new projects will be the only way an economy will be sustainable. So the argument for and against government borrowing to finance their investment expenditure. Okay, yeah, they said no before there. They said they said this is because government must also invest in the future. The government faces the same choice as a household about how to finance investment. For example, a household might want to buy a new car. The car will be used over a number of years. Should it borrow the money and spread the payments over those years, or should it pay the full sum of the full sum at the start? If it borrows money, it will pay interest. So the overall cost is likely to be higher. But if it spreads the payments, this more accurately reflects how the use of the car is spread over time. Then the position will come into it. But there are arguments for and against government borrowing to finance their investment expenditure. With political pressure to keep taxes low, government over the past 20 years have increasingly argued that at least a proportion of investment expenditure should be financed through borrowing. At the same time, over the trade cycle, there should be a current budget surplus. So the surplus is then used to cover whatever investment spending will not be covered by borrowing. So it's all about opportunity cost here. So if government has to, it's important for government of a country to invest in capital goods. And investment in capital goods cannot be done because you have current expenditures. So the current expenditures cannot wait. But investment in capital goods are for the future. So you can as well borrow to do that instead of borrowing for day-to-day expenditure. That is the point here. But for government, and based on the fact that most of the time opposing parties, whenever they want to campaign against the government, they use a high tax rate, like, oh, you guys are paying more taxes. In our own regime, if we have power, they use tax bait as they use tax as a bait.
Also, they use public national debt as a bait.
As a bait. So that's why government of the day would find a way to ensure that it does not charge high tax. And in the course of doing that, It will only try to, invest in capital goods, but putting into consideration how the trade cycle can flow. Because if the trade cycle is improving, it simply means the GDP of that country is improving, and whatever they get in terms of returns can be used to service the loan or pay just the loan.
Okay.
So, well, it is all about the government of the day making a decision here. The decision is taking a borrowing for capital expenditure, using its own revenue to sort current expenditure. And whatever has happened with capital, whatever borrowings are, the current expenditure, because the economy is booming, would be able to, generate revenue to pay off the debt. So that's why government will tell you that we have sustainable plans. So whatever is happening now, yeah, we have debt, but there is a plan towards reducing this national debt.
Okay.
So a decision can also be made between primary budgets. It's almost 4 minutes. 4 minutes, just.
Okay, stop.
Okay.
So if you want me to send it to you.
Not maybe later.
Okay.
So a decision can also be made between primary budget deficits or surpluses and actual budget deficit or surpluses. The primary deficit is the actual deficit but does not include interest payment on the national debt. Therefore, primary deficit plus debt interest payment is actual deficit. So for primary deficit, it's simply about payment that does not involve any transaction, like welfare payments, like unemployment benefits. These are payments done by government. So no interest is being paid on that, because individuals that get it through taxpayers' money. Are you with me?
Yeah.
So that's why this primary deficit plus debt interest payment is the actual deficit. So there's a primary deficit, which is based on the fact that government is spending more than what it has for unproductive issues, for unproductive situation. So if a government is in financial difficulties, it might find it difficult to borrow more money on the world financial market in order not to increase the size of its national debt. It then needs to run a primary surplus that is at least equal to the debt interest payments. So now we go to the factors influencing the size of fiscal deficit and surpluses and the national debt in nominal terms without inflation here. So what are those factors influencing the size of your deficits or surpluses, and how much more you can take, how much more you can be attracted to national debt, or you can, find a way around national debt? Can I get the phone now, please?
Yeah.
Okay. I think I want this side, so.
Okay.
Yeah, I want this side. Okay. Video. Okay. Why video changes like that? I don't know. It's fine.
It's fine. It's not gonna appear.
Okay. So what are those factors influencing the size of fiscal deficit or surpluses and national debt? First, when we talk about fiscal deficit, we already know what fiscal deficit is. It simply means government budget, government spending is more than its revenue. And it simply means government might as well borrow to finance its spending. And the surplus, if government spending is less than its revenue. Then there's national debt, which is an accumulated deficit. So what are the factors that influence deficits, surpluses, and national debt? The first one is state of the economy. There's cyclical deficit and surpluses, which are caused by the effect of automatic stabilizers on the level of government spending and tax revenue. They are out of the government's control in the short term. For example, a downturn in an economy is likely to automatically increase the government spending on welfare payments, and at the same time reduce tax revenue as tax receipts from direct and indirect taxation fall. However, the size of this cyclical effect will vary from country to country depending on welfare and tax system. So the first factor we're going to talk about here is the state of the economy, where we have the cyclical deficit. For cyclical deficit, it simply means for the cyclical deficits or surpluses, we need automatic stabilizers. And for automatic stabilizers, it's about what happens with the economy. If the GDP is growing, if there's recession, government will spend more. in terms of spending to increase aggregate demand. And during boom, government will spend less because revenue would increase. So the size of the national debt or the size of deficit or surplus is based on how the state of the economy in terms of is the economy in boom, is the economy in recession. So that's for cyclical. So the impact of government finances varies with the severity of the recession or the size of the boom of a boom. So the 27 and 2008 financial crisis hit government finances hard because for many developed countries it was worst recession experienced since the 1930s. Discretionary fiscal policy is used by government to deliberately manipulate economic activity. For example, in a recession, a government might deliberately increase its fiscal deficit to provide an extra stimulus to the economy. So the state of the economy is simply about how the economy is at that period of time. So if the economy is in recession, government will actually spend more. If the economy is in a boom, government will spend less because tax revenue would increase. If the economy is okay, yeah, they said that's about the size of the cyclical effect anyway. And also they talked about government finances, the recession size, how big is the recession and how big is the type of boom you have, and that also depends. So if the recession is huge, like the one of 2007 and 8, if it is huge, it simply means the economy might run in a lot of debt to ensure that the economy is still moving or working. So at that point in time, government might have to use discretionary fiscal policy to deliberately find a way to increase economic activity. And what will government do here? Government would come up with investment in infrastructure. Government will come up with investment in healthcare, because investment in infrastructure and healthcare would increase both the physical and mental health of workers, and also would increase attractiveness of foreign direct investment into the country. So if government is despite the fact that the economy is in recession or things are not booming, the government is still trying to invest in infrastructure. This might be an incentive for foreign direct investment to come into that country. And before you know it, the economy might, as just start, booming again. Or recover, then boom. That is state of the economy. Any question about state of the economy?
Yes.
State of the economy, that means we're talking about one factor that could affect the size of the deficit, the size of the surplus, and national debt. Now, the second one is demographic factors. Let's stop this one here. Should I start another one immediately? Okay. Another factor is demographic factors. This is about the population. The size and age composition of the population may affect the size of the fiscal deficit. For example, if an economy has an aging population, the government is likely to be under pressure to increase its spending on healthcare to maintain the quality of life for this age group. With increased medical advances and rising expectation of treatment available, government spending overall may rise as a result. So for demographic factors, we're simply talking about the age of the population. And a population that has the largest proportion or the largest percentage of its the largest proportion of its population in the aging category, then this means government has to spend more on healthcare and welfare. And at the same time, that economy would have reduced productive capacity, which simply means government might not be making so much in terms of revenue, and government will start spending more. So an aging population is likely to have a deficit and increasing national debt than the surplus. I think that point is clear about demographic. Then we have responsible government financing. Many countries, both advanced and developing, are more aware of responsible government financing as a result, either by choice or by terms dictated by the institutions such as the International Monetary Fund. We talked about IMF before, right? Or the Eurozone countries, the EU. Governments have deliberately cut spending and raised taxation to reduce fiscal deficits to target levels. For example, Indonesia has a fiscal deficit limit set at 3% of GDP. So in 2016, the Indonesian government deliberately reduced government spending to prevent the fiscal deficit becoming too large. So it's about governments taking responsibility here. No matter what's going to happen, our deficit must not exceed 3% of our GDP. So as soon as it reaches 3% GDP, we don't do anything. So that is government taking responsibility here. So it's just about government being fair about how it wants to manage its deficit. So it simply means government can as well control its deficit, government as well control its national debt. That is what government responsible is here. Do you understand the point here?
Yeah.
So government responsible towards spending is based on how much more they want to spend, from how much more they want to borrow to finance public spending. And Indonesia is an example used here. They said we're not going to have a deficit more than 3% of our GDP. Because having a deficit of 3% means in the next year, we only have to increase our GDP by 3% to cover up for the previous deficit. Is deficit clear? So that's another factor that will determine deficit, surpluses, or national debt. The next factor here is taxation. The size of the tax base might increase if new taxes are introduced. This will reduce the fiscal deficit. For example, between 2014 and 2017, Malaysia's fiscal deficit fell from 3.4% of GDP to 3% of GDP. This was achieved through deliberate government expenditure cuts, which is government responsible there. An introduction of a good and service tax, that's VAT, in 2015. Equally, the efficiency of tax collection might improve. For example, government new technology. A government might also prioritize the reduction of tax avoidance and tax evasion. All this will help to reduce the fiscal deficit. Now, let's look at taxation as a whole. Malaysia is able to reduce its fiscal deficit, maybe because it's able to, to use technology. It's able to reduce tax avoidance. It's able to reduce tax evasion. And if all these are done, it simply means government will be able to, recover a lot of money that has been hanging on there based on inadequate structure to generate taxation or tax. So most of the time, this is the problem about developed African countries or developing countries. They don't have a structure in place that would allow you not to be able to avoid or evade tax. Because if you are able to find a structure that allows you to evade, or that if you cannot avoid tax, if you cannot evade tax, it simply means you have to pay the taxes, and that reduces tax deficit. That reduces deficit for government, and that was what Malaysia did. I think you get it.
Yeah.
That's one way. Another one is you deliberately cutting expenditures or increasing taxes. But most of the time, it's not about just increasing tax. It's about the way you collect these taxes. If taxes and if people find a loophole in your structure, they use it to their own advantage.
Mm-hmm.
And that's the point about taxation. So taxation is just about how a government is able to ensure that people, institutions do not evade or avoid tax. And before you know it, deficit will start reducing. So it's not just increasing taxes, but finding a way to ensure that no one is avoiding or evading tax.
Mm-hmm.
I think that point is clear about taxation.
Yep.
Okay. So which is also another factor that determines the level of your deficit, the level of your surpluses, and your national debt. Okay. So next one, let me stop this video. Then we'll do another one. Then, okay. The next one is economic developments. In developing countries, government spending may be linked to economic development. When the economy is doing well, there is a temptation on the part of the government decision makers to assume that it will continue to do well in the future, borrowing a little more to finance a favorite spending project or provide a tax cut for core voters can become too attractive to resist. Government might be tempted to believe that because there's economic growth now, it will continue towards the future. And as a result of that, they become generous, probably because they want a re-election. They start cutting taxes. They start spending on some infrastructure that are not necessary at that point in time. And before you know it, things change and debt increases. And that's the point about economy. So economic development sometimes might be a temptation towards spending more than what you think. So you are projecting the future without putting into consideration external factors that might occur. So that's why most of the time, government of countries, they're always conscious because there are some things that are beyond their control. War is beyond any country's control.
Unforeseen events.
It's an unforeseen circumstance, yes. And if you have projected, if you have spent towards believing that things will be the same way as it were some few months, then there's a problem. I think the point is clear about economic development.
Yeah.
Okay. Then we have price of commodities. For price of commodities, we're simply talking about raw materials mostly. So the tax revenue for some countries is heavily dependent on commodity prices. For example, for Saudi Arabia and the UAE, the amount of tax revenue in a year depends heavily on the export price of oil. For these countries, the structural deficit will increase if a fall in the price of oil is sustained over time and not related to a trade cycle. So the price of crude oil. If the price of crude oil increases against the budgeted plan, that means if the price of Brent increases, it means countries like Saudi Arabia and UAE, which are solely dependent on exportation of oil, will have a structural surplus.
Okay.
And a fall in Brent prices means they might run through a structural deficit.
Okay.
And that is price of commodities. Do you get it? So here it does not depend on the trade cycle. It's all about what you produce as a country. That's why it is structural. I think it's clear.
Mm.
Then we have debt interest. This is the amount of money you pay when you take a loan. So let's see. Debt interest is part of a fiscal deficit or surplus. The larger the debt interest paid, the larger the deficit or the smaller the surplus. Debt interest is determined by two factors. One is the size of the national debt and the total amount the government owes to its creditors. The other is the rate of interest it has to pay on its debt. The higher the average rate of interest, the higher the debt repayment. New borrowings take place at current market rates of interest. I think we talked about fixed rate of interest yesterday. Okay. So new borrowing takes place at the current market rate of interest. So the rate of interest paid on new borrowing will depend on two factors: the market rate of interest at that time and the credit rating of the government. So if the government is seen as being able to repay in the future, its credit rating will be high and it will be able to borrow at relatively low rates of interest. If the government is seen as being at a risk of not repaying, then it will have to offer a relatively high rate of interest to cover that risk. Strangely, it can be the case that the government increases its borrowing substantially, and yet the total amount of interest paid on its national debt falls. This will happen if it's able to refinance part of its debt at much lower rate of interest. So an increase in the national debt does not necessarily mean an increase in interest payments on national debt. So now let's take it one at a time. The debt interest. Government could borrow through IMF, government could borrow through financial institutions, government could borrow through different sources. The amount of, but for borrowing, it attracts interest. So if you are borrowing right now, it has to be the market rate of now. It is not fixed. Do you get the point?
Yeah.
So because that is the only way financial institutions or borrower or lenders will be able to make profit. They only want to talk about a fixed interest rate if it is expected that interest rate is going to drop in the future. Then they want to leave it at the present or the current price. It's at a fixed rate. But all in all, if government of a country continue to borrow, it will affect the national debt, and because it has to pay more in terms of interest rates. But if a country is a country that is attractive to financiers or to lenders, that this country will be able to pay back, the government of that country might be able to negotiate for a low interest. And because it's able to negotiate for a low interest, it reduces its deficits. But if it's a country that is not likely to pay back, it's a huge risk for financial institutions. As a result, they have to cover that risk by charging a higher interest rate. I think it's clear. And the higher interest rate will bring about an increase in national debt, an increase in the fiscal deficit, or a deterioration in the fiscal surplus. On the other hand, that is for credit rating anyway. On the other hand, we talked about refinancing. Sometimes because you are able to take a loan, you might take a loan from IMF and use it to refinance or to pay the other debts. So you are able to do this. As soon as you are able to do this, that reduces your national debt. So sometimes you can borrow to pay some debt. And because you have borrowed to pay some debt, it reduces your national debt. But that does not reduce, it reduces your national debt and it reduces your interest, the rate of interest. But because now you've borrowed just from one individual or from one institution to pay other. So that means that other institution that you've paid is out of it. So your debt, the national debt has reduced, and the interest that you are supposed to be paying every now and then reduces. Unforeseen events. That's another factor which is beyond the control of any other person or any nation. They said, occasionally, I think I stopped this. It's minutes already. Yeah. I think that's the last one I'm going to do for this. Take it. No, you can take it now. Next one is going to be the significance. So for unforeseen events, are you there?
Yeah.
Occasionally, government have to respond to major unforeseen events which cannot be covered by monies set aside for these situations. Floods and other natural disasters are likely to have a high impact on, for example, France government finances, but they might have a devastating impact on a small economy such as Haiti or Jamaica. However, the financial crisis of 2007 and 8 showed that major economies can be at risk from unforeseen events. Between 2007 and 8 or 9, many developed countries such as United Kingdom were forced to nationalize. In essence, buy banks and other financial institutions that were at risk of failing. Remember we said banks are too big to fail. Banks are too big to fail because as soon as they are getting closer to bankruptcy, the government has to take charge.
Mhm.
If not, then the economy will collapse.
Okay.
And that is what happens in the UK in 2009. So the purchases are typically not seen on data relating to fiscal deficits in those years because they are excluded as one-off item that would distort the usual pattern of fiscal balances. However, 60 billion pounds used to prevent banking collapse in 1 year in the United Kingdom, then an extra 60 billion added to the fiscal deficit for that year. Equally, sales of state-owned asset privatization would reduce a fiscal deficit. Now, another factor that increases national debt or fiscal deficit or surplus is nationalization and privatization. For nationalization, it simply means private-owned sectors has been taken over by government. Example is the banks. The banks are taken over by the UK government because the banks will collapse. So the UK government had to spend 60 billion that was not budgeted.
Okay.
Are you with me? So the UK government has to spend 60 billion that was not budgeted. And that increases what? That increases its national debt. It increases national debt, it increases the fiscal deficit. But when it comes to privatization simply means government is going to make revenue from the sales of its assets. And that should reduce deficit or increase surplus. And if it's reducing deficit, it might as well reduce national debt. Is it clear?
Yeah.
So these are the factors that affect, that influences national debt, that influences deficit and surpluses. I think they are clear. So now we go to the significance of the size of fiscal deficits and national debts. Are you there?
Yeah.
Okay. The significance of the size of fiscal deficits and national debt. The size of fiscal deficits or surpluses has implications for other economic variables. So the first one is the impact when we talk about economic variables, we're talking about interest rates, inflation rates, and the rest. So let's start with interest rate anyway. All other things being equal, a rise in government borrowing in the national economy should lead to a rise in market interest rates in that economy. This is because the demand for borrowed funds rises relatively to existing supply. The price of borrowed money is the rate of interest. So the rise in demand for borrowed funds leads to a rise in interest rate. So this may crowd out private sector spending. However, this rise in interest rates may not happen for a number of reasons. But before we go there, interest rates. If government borrowing increases,
Yeah.
it simply means there's few left for private sector to be able to borrow. And that simply means rate of interest would rise. Does it make sense there?
Yep.
Okay. So, however, the rise in interest rates may not happen for a number of reasons. Number one, the increase in government borrowing may be relatively small and so have a barely noticeable impact on interest rates. So there might not be a rise in interest rate if government borrowing is relatively small. Two, if the central bank is operating a policy of quantitative easing, the government is likely to be. Oh, I need to make a video for that, sorry.
Okay.
Thank you. Okay. So, like we start with the significance of the size of fiscal deficits and national debt. The first one I'm talking about is the impact on interest rates. Yeah, first, interest rate simply means the price of borrowing, the price of money, which is the price of borrowing or the benefit of saving. So, a rise here has been written, they said, has been read, they said a rise in government spending, a rise in government borrowing will bring about a rise in interest rates. Why and how? With government borrowing, it simply means if the government starts borrowing, it simply means there's few left for the private sector or the free market to be able to borrow from financial institutions. As a result of that, demand for borrowing would rise, and there are few borrowing available. So a rise in interest rate will occur. So there's a rise in interest. As soon as government start borrowing from financial institutions, it will bring about a rise in interest rate because the demand for borrowing would increase. And as soon as demand for borrowing increases, the rate of interest rate increases, except if one, government borrowing is relatively small and it's barely noticeable, then if there won't be a rise in interest rate. Two, if the central bank is operating a policy of quantitative easing, and when we talk about quantitative easing, it simply means
Buy corporate bonds.
bonds to ensure that commercial banks have a lot of money in supply. Having a lot of money in supply reduces the rate of interest. Three, the government may borrow on the international financial market. So the government is not borrowing locally. The government is not borrowing through financial institutions. The government is borrowing through maybe International Monetary Fund or other international body. So that means it's not going to affect domestic borrowing. So there's still more money for domestic firms to borrow. That's the third reason. And the last one, in a recession, government borrowing is likely to rise, but private sector borrowing will fall as investment and consumption fall. Reduced private sector borrowing reduces any impact on interest rates of higher government borrowing. So, and the last situation is, this is part of the trade cycle here, which is recession. During recession, government would borrow during recession because during recession, aggregate demand is expected to fall. And the only way government would not be able to rely on revenue generated through taxes because VAT would fall, corporation tax would fall, income tax would fall, tariffs would fall. So, which simply means all avenues which government might be able to make revenue through taxation would fall. And government need to execute the budget. That means government will borrow. But the private sector would not borrow during the recession because economic activity are in decline. So there's no reason for private firms to borrow at that period of time. Which simply means no matter how much government borrows, it's not going to affect the interest rate. So these are the reasons why an increase in government borrowing would not affect the interest rate, would not increase the interest rate. The first one is that the borrowing is relatively small. The second reason is that the central bank of that country is operating a policy which is quantitative easing. The third one is that the government of that country is not borrowing domestically. The government of that country is borrowing maybe through IMF. And the last one is that the country is already in recession, which simply means private sectors do not need to borrow. And as a result of that, the central bank does not have any reason to increase the interest rate. I think interest rate is clear there.
Yeah.
Any question about the interest rate?
No.
Good. Okay. Please, can you just send that to me now? Okay. Everything at the time.
Yeah.
Aisha is going to go.
Yeah.
Okay, so now let's see.
Did you get the request?
Okay, yeah. Yeah, it's coming. Thanks. I think everything will come.
Yeah. Just need to keep the phone open.
Open, yeah, it's open. Okay, so we'll move on.
Okay.
Okay. Angela, thanks. All right, we'll move on. So we have yeah, they said okay. I'm still continuing. It said okay, now we understood the reasons why we might not as well have increasing interest rates, even if government borrowing is increasing. But not most of the time, without all these conditions, an increase in government borrowing would increase interest rates, except for this condition. All things being equal. Now, in 2010, some economists and politicians were warning that growing national debt and fiscal deficits would reduce the credit rating of some governments. As a result, the interest rates these governments paid on their borrowing would increase significantly. Credit rating for large companies and governments are given by private sector companies, such as Moody's and Standard & Poor's. They estimate the probability that a company or a government will default on its debt. In essence, not pay interest on it or not pay it back on time. So the best credit rating is AAA and the worst is D. Credit rating influences the rate of interest at which the companies and government can borrow. The lower the credit rating, the higher the rate of interest savers demand to buy the bonds or debt issued. So for credit rating, it's simply talking about how you are being rated in the market for lenders. So if you have a low rating, it simply means you are a high risk for lenders. They would not want to borrow you. That means you have maybe a D. But if you're having a triple A, as been said here, it simply means you are a low risk and you'll be attractive. Lenders will want to give you money. They will even approach you without you approaching them. Do you get the point here?
Yeah.
So it could be argued that more debt issued by a company or a government, the lower should be its credit rating. So more debt equal more risk. However, in reality, the situation is more complex. If a government or company has little debt in the first place, the doubling its size is likely to have no impact on the risk of default. They said if a government or company has a little debt in the first place, doubling its size is likely to have no impact on the risk of default. Yeah, if you are just taking a loan for the first time, or you don't even have a loan, yeah, you are taking a loan for the first time. So your rating, there won't be any rating for you because you don't even have one before. So firms or the financial institutions might as well want to give to you. Equally, credit ratings are relative. Savers have to put their money somewhere. For example, the US and UK government have never defaulted on their debts, despite the fact that they borrowed significantly during the recovery from the financial crisis. They are seen by savers as very low credit risk. So look at, I told you earlier, when we talk about government is a safe place. Savers want to save their money. And the only secured place is through government. So they want government bonds because government bonds is more of a security. And making mention of US and UK here, they are responsible governments because they pay back their debts. They don't owe their lenders.
Yeah, okay.
Do you understand? So such government would have a good credit rating. Do you get the point here?
Yeah.
So it's just about how responsible the government is, how responsible the company is. A company that pays back its loan, pays back interest before it's due or as at when due would have a good credit rating. Is it clear?
Yeah.
Now we go to debt servicing. That's another factor. For debt servicing, it refers to the regular repayment which needs to be made to the lender on outstanding loans. This includes interest repayment. It has been explained above that a rise in government borrowing is likely to lead to a rise in the amount of interest paid on the national debt as it goes in size. However, the impact on debt servicing depends vitally on the rate of interest on current borrowing. That is if it is not a fixed interest rate. So if interest rates are rising, debt servicing will considerably add to the fiscal deficit and to the national debt. So if interest rates fall far enough, for example, because of quantitative easing, then higher borrowing and a higher national debt can be associated with a fall in the total amount of interest paid on the national debt. For debt servicing, it simply means you have to continuously pay certain amounts on the loan, or interest on the loan that you already had.
Okay.
So if interest rates continue to rise over time, because you have to pay at the current price, at the current rate, it simply means it will increase your deficit and at the same time increase your national debt. On the other hand, if the interest rate is falling, because the interest rate is falling and you have to pay at the current rate, it reduces your deficit, it reduces your national debt, and it might as well increase or improve your fiscal budget. Does it make sense there?
Yeah.
So that's about debt servicing. Debt servicing is simply interest that you have to continue to pay on your loan. So if the interest rate is increasing, you have to pay a high interest rate. It increases your deficit, it increases your national debt. If the interest rate is falling, it also have impact. It reduces your deficit, it reduces your national debt. That's about national debt. Then we have intergenerational equity. For intergenerational equity, it refers to fairness between different generations. Some economists and politicians have argued strongly that increasing fiscal deficits and national debts benefits current citizens at the expense of future generations. However, others argue that high fiscal deficits and national debts today do not create a problem for future generations. In fact, there are arguments to support both views. So, for intergenerational equity, for economists and for politicians, the first argument is that the debt of today might affect those coming after us because it's not sustainable. Then some argue that the debt of today does not have any impact, does not have any effect on the generation to come. So let's look at the arguments now. They said if national debt doubles today, it will be left for 50 years from now to pay it off. What is important from year to year is the cost of financing the debt. So the history of the past 100 years suggests that the national debt declines in relative value over time because of the effects of inflation, which slowly decrease the real value of the debt. Time also allows GDP to rise significantly, making an interest payment more affordable to repay in the future. So it is not necessarily the case that future generations will not benefit from an increasing fiscal deficit and national debt today. Now, let's look at it this way. The point that supports intergenerational equity is this. The debt of today does not literally have a negative impact on the future generation. Why? There's inflation. With inflation, borrowers are better off. Yes or no?
Yeah.
Why are borrowers better off? They are better off because the amount of money they take today, the value has dropped compared to what it's going to be tomorrow because of inflation. So which simply means if a country has financed infrastructure, invest in capital goods with borrowings that has to be paid back in the next 50 years. The investment, the infrastructure within those 50 years, year in, year out, would have covered that amount to be spent. And the infrastructure might as well spend more than 50 years before thinking about getting a new one. So which simply means the future generation would as well benefit from the debts of the past years.
Okay.
Do you get it? And also, aside inflation, the GDP of 50 years ago is not the same as GDP of today. So which simply means that amount you borrowed some 40 years ago, even if you want to pay it back now, it's just few proportion of what your GDP of today would be. So if you have borrowed maybe 1 million now, in the next 40 years, 1 million of now is just going to be equivalent to some thousands of them.
Yeah, because of inflation.
And your GDP at that time will just be a little proportion of what it is right now.
Mm.
Do you understand? So that's why it is not necessarily that the case that future generations will not benefit from an increasing fiscal deficit.
Mm.
Because it will be more affordable to repay at that point in time. Is it clear?
Yeah.
So there are several arguments to support the view that future generations suffer. Now let's look at the argument against intergenerational equity. If the real cost of financing the debt becomes too high, this will create a cost for future taxpayers. Tax rates are likely to rise and government spending may fall. For example, future generations may experience cuts in welfare payments and the range and the quality of public services may fall. Also, increasing fiscal deficits and national debt will cause rising interest repayment for the government. if interest repayments are a large proportion of government spending, this will create a high opportunity cost on other components of spending. This might negatively impact future generations. For example, if education budgets today are lower than they might otherwise have been, then this might limit the skills of the future labor force. Now, the argument against intergenerational equity is that if the future generation might suffer, and how, if the cost, if whatever we have taken today, if whatever the country has taken as in terms of a loan has to be paid in the future, and the country repayment formula is through taxpayers, which simply means the country probably does not have resources. So everything has to be done through taxpayer. It simply means the future generation will pay more tax. Do you get it here?
Yeah.
So paying more tax means less disposable income for the future generation, and that might reduce the quality of life for future generation. So that's the argument against intergenerational equity. The first in support is that inflation might occur, and the GDP might be a higher percentage of whatever the loan you have taken in the past. But the argument against this is about taxation. If a country only relies on taxation to pay its debts, it simply means there will be continuous increase in tax for future generation. An increase in tax reduces disposable income. And when disposable income is reduced, it means the purchasing power of household reduces, and that reduces the quality of life of future generation. Do we get it?
Mm-hmm.
There are also arguments to support the view that future generations might gain from a high fiscal deficit and national debt today. If the deficit is used to finance long-term growth, then the future generations will benefit. Living standards will potentially be higher for future generations. Investment in infrastructure today, such as new hospitals, schools, will benefit citizens in the future. Also, national debt today can benefit future generations through the wealth effect. Government bonds owned by households are assets. This wealth can be passed on to future generations. Holders of these bonds through the generations will continue to receive interest on this wealth. So finally, there's an argument to support the view that current generations might benefit from a high fiscal deficit and national debt today. High government spending relative to low taxes is likely to benefit current generation. For example, they might benefit from well-funded job creation schemes, high state welfare payments, and care for the elderly paid for by the government. So the impact of fiscal deficit and national debt on intergenerational equity can therefore be debated. Those who support reducing the current fiscal deficit and national debt have supported austerity measures. In some cases, government spending has been cut drastically and taxes increased in an attempt to reduce the fiscal deficit. This policy has caused some problems for particular age groups. If the economy slows down as a result of fiscal austerity, the youth suffers. That's the point. Unemployment rate often rises faster than overall unemployment rate. In recent years, both young and old have been affected by economic events differently. However, much of this has been caused by factors not limited to fiscal deficit and national debt. For example, young people entering the job market between 2008 and 2014 in many developed economies have found it difficult to get reasonable paid jobs. That has been a consequence of the financial crisis and not necessarily fiscal deficit or national debt. Now, let me sum it up. For intergenerational equity, there's the support that national debt, fiscal deficit of today will be beneficial for those coming after us. Because one, if it is channeled into the right direction on infrastructure, on education, on healthcare, the future generation will benefit. But if it is channeled on current expenditure, it will affect the future generation, because it simply means the government does not have any source of revenue than taxes. I think it's clear.
Yeah.
And whenever we talk about intergenerational equity, we have to put into consideration different variables such as GDP, inflation. GDP, inflation. I think those are the two things we can talk about. Yeah, GDP, inflation, and government spending. So those are the things that will determine intergenerational equity. I think it's clear.
Mm-hmm.
Now, the last one we have here, I think is the last one here. Yeah, it's the last one is foreign direct investment, which can also have impacts on national debt surpluses, national debt and fiscal deficits. Countries with very large fiscal deficits and national debts are more likely to have problems financing those deficits than those with low fiscal deficits and national debts. If a government has borrowed from abroad, it may struggle to obtain enough foreign currency to make repayment on its debts. One way of getting foreign currency is to increase inward foreign direct investment. However, countries which have severe fiscal problems are more likely to see FDI decrease. This is because the economy may be going through a deep recession as the government cuts back on spending and increases taxes to deal with its fiscal problems. The recession is likely to, this recession, the recession is likely to make investments in firms producing for domestic market deeply unattractive. Now, foreign direct investment.
Yeah.
If a country has, taken a loan in the international market, continuous borrowing in the international market means you have to pay back in foreign currency. And to pay back in foreign currency, you need to attract foreign direct investment. Can I make a video for that, please?
Yep.
So for foreign direct investment, which simply means inward investment, foreign direct investment for multinationals to stay in your country, or for multinationals to be attracted to your country, it simply means you have a fiscal surplus. If your country is running through fiscal deficit, mostly if the borrowing is done through the international borrowing market, it simply means you have to pay back with foreign currency. This means a lot of taxes has to be paid by multinationals in your country, because there's no way the country wants to do it than to increase its taxes to pay back its deficits. So this means multinationals in your country, multinationals in such country might have to pay more in corporation tax. That makes them that becomes a disincentive for them to stay. They might as well want to leave the country, and such country will not be a country of attractive, will not be attractive to foreign direct investments too. So a country with high national debt or large fiscal deficit will find it difficult to be a place that is attractive for foreign direct investment, because everything will be on the foreign on these investors or these multinationals to pay more so that the government can service its debt or reduce its national debt. So that's about foreign direct investment. So a large national debt or a large deficit becomes a reason why multinationals or FDI will decrease in your country and might not even want to come to your country. I think it's clear. So FDI is also significant. So for you to attract FDI, your country must be a country that is not having a fiscal deficit, or that's not having a large fiscal. Yeah, every country could have fiscal deficit, but it's not having a large fiscal deficit or national debt, because that country will not be able to pay back. It will rely mostly on multinationals. And multinationals, they want to come to your country to make profit, not to continue to pay taxes because you have to pay your debts. I think it's clear.
Yeah.
So that ends public sector borrowing and public sector debts, and that ends the live section. Thanks for all the viewers, and I appreciate you all. So the live ends now. Thank you. Bye. Cheers. Thank you.